Hello, everyone, and welcome to TBR's webinar, Infrastructure Management Transitions, A Tale of Two Profit Pools. I'm Justin Sargent, and I'm hosting today's session. The information management market faces disruption on two fronts. First, customers increasingly deploy applications and workloads on cloud-enabled platforms, which require new types of management solutions. Second, this consumption model shift means customers want to buy and deploy cloud management solutions as they need them, increasing the need for services-based solution deployment. This changes the revenue mix of vendors from traditional license and maintenance streams to annuity-based subscriptions, impacting profitability and margins in the short term. The insights shared in today's webinar from our infrastructure management software vendor benchmark. If you'd like to learn more about this report, please reach out to myself or one of the analysts after the presentation. And before we begin the webinar, there are a few housekeeping items I'd like to cover. First, we'll be recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to watch this presentation or any of the previous webinars we've posted. Second, we'd like to hear your thoughts and opinions on today's presentation. Please send any questions to the Q&A function, and we'll address them at the end of the webinar. And third, we'll be sending out the slides and link for the recording for today's webinar within 1 business day of the conclusion of the webinar. You can also find the slides as well as our other webinars at slideshare.net/TBR_market_insight. Now let me introduce the analyst presenting today. Geoff Woollacott is a principal analyst in TBR's software practice and oversees the syndicated research team for the software and BI services practice. And Andrew Smith is an analyst in TBR's software practice and leads quarterly syndicated research on top infrastructure and systems management software vendors, including Dell, HP, IBM, and CA Technologies. And with that, let me hand this over to the analyst.
Thank you, Justin. One of the comments we've received on some of these webinars is audio quality. Given we have Soviet Union era phones that we're speaking into, we want to make sure we're loud enough that you can indeed hear it. So if you need us to speak up, please put that into the chat function so you'll know you'll be able to hear us. What we'll go through is some of the content enhancements. This was bigger last time around for us. This is quarterly, as we said. But as I had said on that one of the big things we're trying to parse out and piece out is the shift from license to subscription, to take a look at the erosions that are going on one side as the other side's picking up. So we're hitting that. We'll take a look at the current market state from the 4Q14 benchmark and what some of the overarching themes are. And then the scenarios that we are talking about at the back end after we flood you with our bubble chart format is we'll be looking at the subscription purchasing, the industry-oriented go-to-market strategy, and then IP development in terms of make, buy, or rely, and what's happening now. So this is the paid ad here for what we have within our software vendor reports. We have about a dozen of the quarterly business reports that are about 30, 40 slides, a lot of charts and graphs. We have the 3 benchmarks, this one being infrastructure management. We have another one on applications and a third in the business intelligence software space, as well as customer studies around BI customer purchase trends that we do in concert with the professional services team here led by Patrick Heffernan. The groupings have remained the same. What you'll see here is on the application-centric side, we added Workday, that obviously they're not discussed in this one. And then on the IM-centric side, what we added was ServiceNow, and we'll talk quite a bit about them in the report. Those were the major company additions to the benchmark suite that we're tracking here, triggered in part by Actuate being picked up by OpenText. So on 1Q15 on the app side, they'll be rolled into the OpenText numbers, so we had to add one as the consolidation goes on. We expect to be doing that in rather fluid fashion, quarter to quarter as various firms rise and fall. So let's get into the overarching themes. Let's just start talking about what's happening here. Andrew Smith is here. He'll be chiming in as I either forget things or misstate them. He's here to keep me honest. The first thing is the long-term success in the IM space is really going to be determined about how well they can navigate the shift into the subscription revenue base, and that's as much for the infrastructure management side of these things. It's as much this overarching industry disruption of how to monetize vendor IP based on shifting consumer consumption patterns as much as it is, the lift for infrastructure management is even more difficult or more challenging than the rest of than apps vendors, for lack of a better way to put it, because they have to bake in new technologies into these things as well, because it's no longer just taking a look what's going on the on-prem side. There's that whole suite of things around orchestration and billing and metering and for internal chargebacks into shifting IT, the departmental structures and usage. So it's a bigger lift for the IM side rather than the app side. It's why we split the benchmark into two, because they got a tougher haul on this side of the shop, and there's a lot of money that's tied up into these sort of middleware apps and infrastructure management apps that they're either going to go away, they're just going to start being baked into app dev platforms. You know, there's a lot of threat here. Secondly, strengthening macroeconomic conditions. That was the dog ate the homework line through a lot of the earnings calls that were coming through, and it was attributed, at least for that quarter, as being tied to the rise in the U.S. dollar. So for 4Q14, that's the relevance of currency fluctuation. But overall, we'll get into a scenario later about how currency fluctuation is just one more influence that's going to have to be considered as you move from license to subscription, and it just adds another dynamic and another level of complexity. And then the third point that we'll get into in some detail here is there was sort of a slowdown in acquisitions around this space in the fourth quarter, and it was much more around alliances and organic product development. So that was a somewhat interesting insight, and we'll get into that a little bit later in the talk. So let's get into the bubble charts. These are the TBR standard looks. This is the aggregate infrastructure management revenue and profitability and year-to-year revenue growth for the baskets. So the bubble is the size of the revenue, operating margin is the x-axis, and revenue growth is the y-axis. So what we're looking at here, you see in the upper left, ServiceNow was added just this quarter. We're looking at them as the disruptor. And then if you go down to the sort of lower right, where CA is sitting kind of buried with Trend Micro on top of it, they're, you know, disruptor and disrupted. Once again, we have Red Hat and VMware kind of at the top of the middle where the green is. We're taking a look at them. Those two are very interesting to us as kind of a hybrid of the old and the new. You know, there's some threats. There's always these push for open standards and a new sort of cloud OS that are kind of threatening both of them at the same time. But they're the de facto standard of how do you monetize in the kind of the open environment world around these things. So they're a unique pair of companies within the more traditional vendors that we've got on there, plus the cloud guys. Then you take a look at Oracle and Microsoft here, where there's cannibalization and margin erosion management, right? Because they're shifting some of these workloads over to the cloud area. They've got to try to find a way to defend what is on the enterprise while they're allowing it to go, and they're very interesting to watch on that front. And with that, what we're going to do is we're going to jump down into, this is the product revenue. I'm not going to spend a lot of time on this because what we have done is we've taken it where we can. We don't do it on all of them because, for example, IBM has when you're looking at the infrastructure and the PaaS component of what they do, they've got that baked over into one side with kind of the ITO and the services organization, so they're not reporting it out. And then for software and SaaS, they've kind of got that bundled together as well. So we're taking a look at the pure plays where we can get a better, accurate picture, or for the ones that are giving us all the income statement balance sheet clues we need in terms of current deferred revenue, so we can get into the book-to-bill ratios and all those wonderful metrics that give you an idea of each quarter how much of it is a recurring revenue stream just being recognized versus the net new. Because we believe, you know, one of these days, Wall Street's going to stop giving the cloud vendors a hall pass on profitability, as Joe Tucci just said it at EMC World, and start expecting to see some returns. And we want to be, what we're trying to be able to do is start to pinpoint, you know, where's the tipping point when the excuse for a lack of profitability can no longer be the idea that you're going to make it up on the renewals. So we're taking a look at this pretty hard. It is going to evolve as we go, but what you're seeing now, we're sort of taking the wraps off what we'll call it as license to subscription 1.0 within these benchmarks. We'll be talking about this in the apps benchmark on Tuesday as well, because this is sort of a joint effort and concerted effort out of sort of one big data file, and then we split it for presentation into these two buckets. So what you can see here on the license growth, there's not a lot of folks that have the fast revenue growth. They're all kind of close to the XY axis. There's the pass play for Microsoft to kind of keep the stickiness there. I'm going to get into that on the next slide, but that's where they're kind of sitting in the corner. You see the model pioneer with Red Hat out there with VMware, Symantec's in there a little bit as well. And the license revenues, they're shrinking, right? You look down in the bottom right-hand corner of this. Our year-to-year growth, or lack of growth, I should say, the year-to-year shrinkage was 3.6%, while overall product revenue, as we defined it, which is license and subscription combined. So the combination is a 1-point year-to-year growth, but in this bucket it was down 3.6%. So if you keep your eye on that lower right, what you'll see is there was 57% growth in the subscription revenue area. So this is what everybody's been talking about. Here are some financial proof points as to what indeed is happening. Now this isn't the full basket of 22. As I said, is it 13? 13. We've got 13 that we're doing so far. So we're taking a look. You can see that upper right. ServiceNow, we just added these individuals, this entity into the benchmark because of their cloud-based ITSM play that has been going gangbusters for them. They're now taking a diversification strategy to take the way they describe their core sort of product is automated workflow management. So that whole thing of tickets and tracking and reporting of what's broken and what's the remediation, call escalation levels, blah, blah, blah. They're taking that to now extend it into other adjacent areas to ITSM. They're getting a little bit into IT ops. They're going to get a little bit into CRM, legal, facilities. They've got the whole expansion plan of the core shell that was Fred Letty's original business plan, that they then took the shell, built ITSM, and now they're going to go back to the shell now that they have the ITSM proof point and try to drive outside the data center and get into some of these other spaces. It'll be interesting to see how well that they do with that. I have Microsoft in there. The PaaS area, we see it as well with Oracle. They talk about PaaS growth. And really, it's a strategic for the hold and grow. If you can get the app dev community writing on your PaaS platform, that's a hold strategy to make sure that what you have on the enterprise, if they're just using app dev, cloud app dev to bring it back home, either way you go, you're making sure that Windows Server and SQL Server all stay required as the workloads shift around. So it's a way to sort of hold where they are as well as penetrate and sort of defend the install base and move into the cloud base as well. So moving on, maintenance growth or lack thereof, depending on how you want to look at it. If you go down to the maintenance revenue was up about 1.5 points. Overall infrastructure management, is fairly flat, as we said. So this is moving a little bit. What you're seeing, that whole basket that's sort of sliding to the wrong side of the XY axis here, that's as much automating services, which in an effort to sustain margins, but at the same time it's just the margin erosion that's coming as you're moving, you're losing the license base and the maintenance piece as it's moving into a subscription. So as I say that, what I can tell you is soon we're going to have to add into this benchmark as we can piece it out, their sort of subscription and subscription plus, however you want to say it. There's going to be a base layer subscription, and then there'll be piece components that will still be rolled into the subscription line that will be kind of value-added services on top of that. So we recognize that as maintenance, quote-unquote, goes away, there's a capture by starting to tier what the base layer subscription is. It's relatively nascent but it's something we're keeping an eye on to determine how well we can model out some of the variations that are going on with that. And again, you see Red Hat VMware sitting there up, sort of lower right. That's been their core. This is the way they've been doing it, and they're handling it very well. While the legacy guys are kind of sliding, you don't want to see your trajectory on this being a down arrow to the left. That's just not that's not a good way to be going. And quite frankly, that's where most of the trending, as you can see it, is occurring, with the exception of the subscription base. Now, on professional services, it's increasingly critical to the IM vendors because, as I stated, or as we believe, and we're not the only ones. We're listening to a lot of vendors say this at the briefings that we go to. I've been a little bit of a road warrior the last 4 months. I've been to Vegas 6 times to listen to various vendors talk about these things. The services business's growth really needs to come in with a proof of concept that explains what is the business value to moving over into these attributes. So the professional services is a lead. EMC, with a renewed federation focus, is one of those areas where they've got to come out to the customer, and by customer it's as much line of business users and all these other things, prove the concept in a simple, easy way to document it, and then bring it back in-house and get it into the IT centers in terms of the ways that they can do it, the orchestration layers that they can move. They've released open products. This isn't in 4Q14, but this is what they've announced to sort of come into the open world a little bit more as a way to make sure that the infrastructure substrate, as Paul Moritz described it just 2 days ago, becomes the de facto standard of the third platform in the new world order, as you want to define it. He described it as the mainframe of the 90s. Well, that mainframe of the 90s is ubiquitous, and the orchestration layer that's required to layer it on top is the reason why the infrastructure management vendors, the legacy ones, have a technology lift to remain relevant. And that's the reason for this split, as I sort of opined earlier on in the discussion. So professional services is where those proof points are going to be had and made. This is an area where you're going to have to be active to give the compelling argument and convince people of the value of what it is that you're talking about. Similarly, you've got to be there to guide it, to make sure that the first test case isn't a bad experience, because then you're going to lose the customer. And in periods of disruption, and this one is the most profound one I've seen since entering the industry in 82, this is the biggest one that I've looked at in that time. And what that means is incumbent vendor status is at the weakest. So services-led proof points is the best way to maintain that account. And if you screw that up, you could lose an account for a very long time if they move over to somebody else's core platform to shift over into the sort of cloud-based orchestration layer, deployment of hybrid cloud workloads, moving at the speed of light back and forth between an on-prem environment and a hybrid.
Yeah, I would add, I don't want to beat this point too much, but I think it's very seriously important, and it's a point that TBR is going to be tracking more in the future as we see, not to bleed too much into what's going on this quarter. I'm trying to keep it to 4Q, but
right.
We see vendors like VMware, we see vendors like CA, Red Hat, having to transition a portfolio because of customer demands for cloud. And some of them are, seem to be having better success than others. VMware is able to take its traditional ELAs and really kind of inject new product solutions, complete proof of concept, and in a way that they're able to monetize this by leveraging a services ecosystem. And then we have vendors like CA who are struggling and frankly don't have the professional services capabilities to kind of back up that shift, because it's not only just about direct sales anymore. No matter how much you're going to train those guys to sell new solutions, train them to help complete proof of concepts. They need, there's that professional services aspect that really can give vendors a leg up over others. That's something that we think is going to be, frankly, very important moving forward.
Right, and if you think of, to piggyback on you jogged another bolt loose in my intellectual junk drawer, is what is also going on here is the move to the cloud is shifting the update cycles and the way in which updates and enhancements are delivered. So the impact there is as much on the traditional system integrator vendor revenue stream mix, because in the old world order, or the way it was explained to me at a SAP conference, is customization versus configuration. So the old world order was you bought the code, your SI came in, made some customizations to the code to get it the way you wanted it, and then every time there was a major update, which happened, say, yearly for this example, they'd come back in and they'd fix what got broken by the update that came from the primary vendor. In the new world order, agile development, continuous update cycles that are streaming out monthly, you can't configure or else it'll blow up every month. You've got to configure in order for that to work. So the infrastructure management vendors have as much a need to partner with system integrators to enable them and strip labor out of their delivery model on what they're doing and serve as sort of the back end when the SIs then write their own white space software applications with the core infrastructure management platform interoperating depending on how it needs to go. So it reinforces this drive to openness that has to happen around data center orchestration layers. It goes to the point that these legacy vendors that are siloed into these disparate pieces that they may have acquired over the years that don't necessarily work together, that isn't going to work as this industry rapidly moves over into the sort of hybrid cloud, orchestration cloud environment that is on its way. With that, the major points that we talked about. So we've got subscription purchasing options. Let's get into that one. We've probably covered most of it in the talk, but let me just make sure there isn't anything I have forgotten. So the customers are increasingly adopting as-a-service IAM solutions, and they're moving away from these traditional license purchases. That's as much because internal IT essentially is competing against these software as a service subscriptions that their lines of business can compete, that can purchase. So therefore, internal IT almost has to have their own cloud orchestration layer for metered billing to go back into the lines of business as IT truly becomes IT as a service, whether you're building it in-house or whether you're just sort of stitching it together from these things from the outside world. And Andrew, is there pieces on the facts here?
Yeah, I mean, in the benchmark, we kind of go into more vendor details. So a couple of the highlights, and these also piggyback off the last segment, but I'll leave that for later. We've got, see vendors like HP releasing a host of new solutions that are based on existing IP, but they're of Vertica and IDLE, but they're meant to kind of monetize. Take advantage of a new monetization strategy, as well as bake new technology into the infrastructure management side. That's kind of the shift that's happening that vendors have to navigate. It's not just about a sales or a professional services strategy. It's about providing the technology as well that aligns with customer demands. VMware is kind of a fun one to watch right now, just because they're in the midst of such a potential disruption with the release of, with kind of the change in their traditional virtualization business and the impact that their new products are having on both their business model and their customers. So we see products like AirWatch, NSX, both changing the transactional nature of their monetization strategies, as well as how customers think about virtualization, how customers think about extending the security, networking, and collaboration pieces that they can build around that ecosystem. So it's really not just about spinning up virtual machines anymore, getting the most out of your storage. It's about moving forward into that value-added space that VMware is looking to grab greater, I guess, brand awareness and market share around.
Right. The interesting play there that I'm looking at is I've listened to quite a few earnings calls, is a lot of different vendors, legacy vendors or existing vendors rather than born-in-the-cloud upstarts. A lot of these folks are all doing the same things, which is taking a flagship product from that legacy world and driving it out into the cloud, giving it away for free or free trials to get it into the cloud and then bake on extensions that are coming off it or around it. The easiest example is, it's not infrastructure management, but it's Office 365, and then when it's up and over onto the cloud, for people who may not have had a server, if it was a small business owner that just had a string of laptops, for example, they may not have used Outlook before, but now that they're on the cloud with Office, they start using Outlook, they start using Power BI, they start using a bunch of different things that extends it. In VMware, we know, right, that they're known for vSphere, they're adding NSX and AirWatch. So vSphere being baked into the vCloud Air componentry allows for that movement that says, all right, we've written around vSphere for the virtualization layer, it's up over on with the cloud service providers, therefore continuing to use this thing and go for the network virtualization and the device-side management around the core that you already have. So it's a nice move to gain the stickiness in the new world order with the existing legacy product and then extend it with all these other attachments that can help drag in some new revenue streams around the core flagship from the old world and the new.
Yeah. Yeah, the last thing I would add is that, you know, it sounds easy when Geoff talks about it, because he's got a way of the words, you know, coming off, but there are some pitfalls and cautions that we've started to see along the way with vendors making this transition, and a lot of it, I think, has to do with kind of what some vendors would refer to as the lumpy nature of renewals. When you're trying to extend these new revenue streams, there might be some initial customer wins that then are not renewed as part of the ELA. There might be, you know, waning customer demand, or they can easily switch to a competitor offering as some fast followers start to move into the market. And that dynamic is starting to put a lot of pressure on vendors to not only make the transition faster, but to start to really deliver that stickiness that Geoff's been talking about, that customer value extending throughout their infrastructure, and you know more than just virtualization or more than just management.
Right. As a senior exec at one of the dinners at one of these briefings said to me after talking about what they were doing, is he just looked at me and said, "Never confuse a clear view for a short distance." And that would kind of reinforce what Andrew was reminding me of. This isn't as easy as I make it sound. We have the easy job. We're just doing the play-by-play announcement. The vendors are on the field getting this done. I had another point and I forgot it after your conversation. It'll jump ahead then when we get back to. Oh, I know, seasonality. This is something that we're not sure if this is going to happen. I think it might, and that is the nature of, if you go to subscription revenue, which is an OpEx basis, as we always talk CapEx to OpEx, et cetera, et cetera. The question of the curiosity that I have, that I'm instructing the analysts to start to take a better look at, is if most public companies end their fiscal year on the calendar year, right? Most people have a December year end. So if most people have a December year end, are they going to want to get, say if they go to a subscription in March, are they going to say, give me a 9-month deal for this calendar because I want it to line up? And if that's the case, then we're going to have these big waves where the fourth quarter could be where the renewal spikes hit. We're not sure about that, and if any of you in industry have thoughts on that, I'd love to have you email me or put it in the Q&A chat box for this. But I'm thinking this may become something that we're going to have to start taking a look at, and that will increase the financial risk associated with the subscription modeling if you're a sort of a small pure play where there could be a big wave in these fourth quarters. I think it also could be maybe they got to shift if you're applying subscriptions, you may be shifting to a January end or a fiscal year for those that you got to try to squeeze in the door so that Wall Street doesn't give you a slap if it didn't go as well as you expected. That was my errant thought that came up. All right, so the next one, America's showing the uneven performance. Well, that kind of steals the thunder of this comment because that was where I was taking a look at it. But what have we got here? It's the performance, everybody was giving us the impacts of these things. So what is happening then is we had strong performance in the Americas in both these benchmarks. Americas in the fourth quarter far exceeded the performance that was being shown in the EMEAs and APJ. So there's two different things going on. There's the factor of currency that we talk about a little bit, which for this quarter was to the benefit of the Americas. But what it shows is that added volatility, if you're getting into the subscription business, now in order to track and figure out what's going on, if it's a 3-year deal, that the tail of that deal may have a radically different value based on currency fluctuations over the 3 years from the time you sign it until you can finally recognize it. So that just adds another layer of instability to this kind of monetization strategy, which has been heralded as being a lot easier because you got a recurring revenue stream, you have predictive revenue, but now you got to get into the currency hedge markets a little better and be a little smarter about what you're doing based on the fact that what you're going to be able to recognize it as is going to shift. So that's a bit of a challenge from the financial aspects. And from there.
Yeah, and just to rip a couple extra data points from the benchmark, we saw that on average EMEA was down mid-single digit for the entire group, and APAC was down mid-single digits as well. So there's certainly some collective misery here across all of the vendors.
Was up what?
Americas was up 3%. So macroeconomic conditions, notwithstanding, this is something that, like Geoff said, there's going to be some analysis here by the vendors to see who ends up coming out ahead. But also from the benchmark, we pull out some of the vendor highlights. Talking about IBM, there's still, I'd say, this is a larger overarching theme that we can talk about on the next slide too, but there's a lot of vendors we see taking an industry-specific approach to new sales models, and I think it's as much a symptom of wanting to add more value as it is wanting to, overcome some of the macroeconomic pressures that are being faced. So focusing on things like healthcare, focusing on things like finance, focusing on manufacturing, kind of adds a niche that vendors can open maybe some more sales doors with, get the foot in the door, that type of thing. And then we see vendors like Dell who are really working on adding more regional sales expertise as well as product development to the mix. So that's enhancing things from Case to StatSoft to Boomi and Katenga. It's about kind of creating a enhanced methodology, but being able to deliver that across specific regional sales groups as well. So Dell has been doing a lot of work there at the end of the year to try and, I think, overcome a lot of these hurdles that we're seeing in the international markets.
Well, right, and as you think of the industry-specific elements, if you're in the heavily regulated industries of healthcare and financial services, one of the biggest challenges to cloud adoption has been whether or not there's a compliance that's required from the regulatory aspect. So HIPAA compliance and having an infrastructure management tool that can facilitate compliance with those issues. For example, if you're sitting up in the cloud and the data's been moved and it gets moved out of country, if you're in the financial services space, you're going to get hit with a regulation aspect. So having a dashboard that provides that and gives the knowledge and the insight as to where it's going and where and when is going to be critical to any of that kind of adoption. So a true behind-the-glass infrastructure management pane into what you're doing around the globe on these things is going to become more and more critical.
Yeah, and the only thing I would add is from one of our colleagues, a simple and an insightful statement about IBM's move to integrate and sell weather company data is that weather company crosses all geographic boundaries. There's little to no restrictions on how and when you can use it, and it's kind of low-hanging fruit in the data analytics world as far as we see it. So thinking about that, smart move there.
Mm-hmm. So next up, you can go right ahead on this one. This is IM vendors, liens, and alliances, a new product development to enhance the portfolios during the quarter.
Yeah, this is a TBR. We kind of simplify go-to-market and portfolio developments into a make, buy, and ally buckets as a way to boil the analysis down. And this is something that a theme that we want to run across the benchmarks and follow this as vendors, change their strategies, change their decision making. And this quarter we certainly saw, or in 4Q I should say, we certainly saw vendors prioritize organic internal R&D over and alliances over significant acquisition activity. We saw vendors in 4Q, more than half of them increase their R&D as a % of revenue. So certainly an internal push there. And I think this goes back to the industry focus. I think it, kind of goes full circle here. What we're seeing, and to bring it back to Geoff's point, even about ServiceNow, there's a push here to find additional value. Salesforce, they did the ITSM thing to some extent, the SaaS ITSM delivery. Now they're looking about where they can expand into customer bases with higher value delivery. And I think that is the reason for a lot of this increased R&D and increased organic innovation. The portfolios are becoming more mature. There is less opportunity to really make that big ticket acquisition that gives you the platform or the infrastructure. Those have kind of been developed, and now it's about establishing that value, establishing consistent methodologies for bringing together all these acquired assets and delivering solutions to market and ultimately monetizing them. So I think this is a push that's going to continue probably into the first half of 2015. A lot of the vendors that we're tracking have continued to keep acquisitions to a low or kind of niche level and really develop their internal capabilities. CA is kind of a poster child for this. For the past 2 years, they've been focused on organic innovation as a way to not only get new products to market, but save money while doing it. And Symantec continues to be an interesting case to watch as they split apart their IM business away from the security business. And then I would mention IBM again. Geoff, you've been tracking the new Watson Health business unit, and that's kind of a great example of taking organically developed IP and then using it in a new business model to deploy additional value. There were acquisitions timed around the release as well, but not as, I don't think, as significant as some other acquisitions have been for IBM.
Right. I mean, the overarching theme with respect to industry marketing is, using a sweeping generalization, I guess what I would say is you can't go deep enough to address the demand for business outcomes around industry. So if you think of the old SIC codes, you used to do, say, 2-digit SIC classifications, you got to go to 4 digits and those kinds of things. And there's just not enough capability to be all things to all people, which heightens the need for the ecosystem development to find the folks with the niche IP that you can bring into your portfolio to scale out through the large vendor go-to-market structure in order to bring it down into these places where it resonates. So the IP developer needs the large vendor for the sales reach, and the large vendor needs a small vendor for the IP that they can gain, suck in through open sort of infrastructure substrates to scale out depending on however that vendor wants to use it. And the key layer to make sure that all that works for the nimble movement of this IP is the infrastructure management layer. And with that, we've concluded the speaking portion of this. We now want to get on to Q&A.
All right, so just a reminder, if you guys have any questions, please send them to the Q&A function, and let's get started. So the first question, what triggered you to take a deeper look at Red Hat's performance?
Well, I've taken a look. I've been reading some blogs to see if I just had left my eye off a ball on something, but the way that I looked at it was to take a look at Red Hat basically built a business around something that was a free subscription. So you could go get the Linux operating system. It was free, and then it was free until such time as you needed the services to be built around it. So how then were they able to build this base that's there? And they have a CFO who's retiring, who's been there for quite some time, who's obviously done a good job in managing and controlling the income statement and the expense lines on these things. And each vendor that has a lot of subscription-based revenue are starting to put out different, what I'll call proof points to validate that the way that they do it and that their go-to-market and that their business management process works. And the line that they use in their calls is to talk about how many of their major, taking the contracts that renewed in the quarter and descending dollar value, what percentage of them renewed and what was the average value of the renewal. So I believe it was in the fourth quarter, they renewed all top 100, and the average contract value increase was 15%. So it was a proof point of that sell, upsell kind of cycle that is an entirely different selling strategy for subscription revenue as opposed to license revenue, and they're putting out that it's working, and it does appear to be working. They have some of the better margin performance for those that are playing purely in sort of the subscription basis of anybody that's out there. So we're doing some research on that. We may come up with a commentary, so if you're a TBR subscriber, you would get access to that commentary. I haven't quite figured out when I'll finish it, but it's something that we're investigating, and something may come up and it may not happen. But that's why we look at Red Hat and are curious on Red Hat. And
yeah,
Andrew,
and the only thing I would add is, Red Hat has Red Hat's a favorable example because it built its business on subscription. So they're the ones, when you're looking at the model, they kind of are in the ideal spot. They give you a window into what needs to be done or what they are doing to achieve that upsell opportunity. Because right now, we're in the midst of the disruption, like we've been talking about for quarters now. And so while some vendors are navigating it better than others, a lot of times it can be hard to tell just because of the shifting monetization strategy. They're losing some of that transactional business in favor of subscriptions. So while the change may not be reflected in increased top-line revenue, some vendors may be navigating it well. Red Hat is Red Hat provides us with a real nice baseline of revenue to tell kind of what's going on, so we have a good insight into that.
Right, and if you, just to jump, because one of the other ones that is listed as a market pioneer in a deployment model, you go to Salesforce, who was, say, one of the first ones to deliver software as a service around CRM. And as we all know in the news, this isn't 4Q14 information, but as we know in the news, they're supposedly looking for a buyer because someone's taken a run at them, and it looks like they're trying to, fall into the arms of another. And supposedly, SAP CEO Bill McDermott said that they would not have any interest in picking up Salesforce because, quote, we have never bought something that was impaired and in decline. And that's an interesting statement. It might be a little bit more hyperbole than fact, but the bottom line is waiting on the profitability has been a long time coming there, and they're potentially were too focused on the innovation of the business model delivery mechanics, and perhaps not putting enough into the R&D to extend the core platform well enough to remain relevant. There's a lot of other folks coming after it with integrated CRM, with that bakes in analytics, stitches it to a marketing platform, and they can trigger it over into e-commerce so that it's that integrated, cloud-orchestrated, full suite that extends systems of engagement into systems of record that needs a very sound infrastructure management layer in order to get done. So that's one that we're kind of interested about. Other questions?
All right, we have a slide-specific question for slide 15. On the service business growth slide 15, what does the legend at the top right corner mean? For example, Dell from 54.5%, 14.8%.
Yeah, so this is, just kind of a housekeeping issue. What you'll see the arrows, you'll see this on all the bubble charts, just because a lot of times some of the vendors are spread over such a wide range that it just becomes unmanageable to display visually. So you see the arrows kind of pointing off to give a general direction with the name of the vendor and their color corresponding to the color key, and the percentages are just their professional services revenue growth, as well as infrastructure management revenue growth. So those are just the percentages where they are on the axes to give you a general idea of their position. But since they're so far off the scale, the bubble is just too hard to display. So that's all those are.
Right. We have to do that with the outliers, or else those that are clustering around the XY axis are just too bunched together. So we have to keep some of them off, and as we add the smaller folks or people have a major acquisition hit that sort of distorts what they're doing from an organic basis, we just sort of use the arrows to keep the core gist of the slide there fairly well put together.
And Geoff is evangelizing, our visual display for these benchmarks. So hopefully, continuous improvement to get the point across and make it so you can take a quick look at the bubble chart and understand what's going on without having to dig into all the all the percentages if you don't need to.
That's right. That was a way of saying that the adaptation from the first time we revised these to the second didn't necessarily adhere to every request that I had put in on visualization. Yeah. Thank you for picking that scab.
All right, next question. Are you considering adding container vendors like Docker to your IM research?
We're absolutely considering the containers are going to be a big, well, it's our opinion, or my opinion, but there's a couple of folks here that share it, that is a big disruption and sort of a pendulum swing back to bare metal compute and store consumption because of what containers can do without the need for the overhead layer of a virtualized instance. And we're doing some research on that. The challenge about adding them is most of these guys are private right now, so when we're trying to get into the financial modeling metrics that are kind of the fundamental underpinning of all of our benchmarks, they're tough from that perspective. But we are, from a qualitative perspective and from an industry disruptor perspective, we are certainly keeping our eyes on containerization. And again, if any of you have any thoughts, comments, or information you want to share about your opinion or questions you want to ask about that, I implore you to email me with what they are, because I'm fascinated by it, and I'd love to hear what you have to say.
All right, I think we only have one last question here. What do you see as the future of IM tech as deployments require increased automation, integration, et cetera?
It's all about automation. It's all about that single pane of management. And in the old days, that single pane of management was described as a way to just take a look inside the data center as a single pane to then go, get the screwdriver out to fix whatever was gone. And that isn't the way. The more we abstract the IP out of silicon and put it up into the software layer, software-defined, whatever you want to call it, to get into a true cloud type of environment, the Skynet that's coming. Infrastructure management truly has to be analytics-driven with the ability to quickly move workloads back and forth depending on whatever set of governance and policies that you put up. It requires an automated self-service services catalog so that the line of business users will have a quote-unquote good customer experience working with IT internally. So the future of it is to me, the end game is complete automation of it all. And the challenge is monetizing the IP investment that will have to be there in order to do it, such that there's sufficient profit coming back to continue the innovation, because where it's going to head, particularly when you have the Internet of Things, is the challenges will not abate, but the desire and the end goal is a completely automated software that just keeps it always up and always on. Anything you would add to that, Mr. Smith?
I would, yeah. I mean, and the development of data and applications, they're just kind of stirring the pot. It's only going to get worse for IM platforms and vendors, so to speak. They're going to have to constantly be kind of keeping up with the whatever the next best thing is, whatever the next popular systems of engagement or system of record are, and to integrate them and really add value. So.
All right, well, I think that's all we have. So thank you, Geoff and Andrew, and thank you, everyone, for your questions. You can follow both the Analyst as well as TBR on Twitter at the handles listed here, and please check out our SlideShare and YouTube pages as well. Additionally, before you sign off, we'd like to ask you to take a brief survey on today's webinar. Your feedback would be greatly appreciated.
Yes, if I could put a plug in there, please give us the unvarnished feedback, both in what we presented, how we presented it, and what else you'd like to see. While they're called benchmarks, I am eager to determine how we can extend them, modify them, evolve them, so that they truly answer questions that you folks out there in the industry playing the game on the field want to know and want to hear about, because this benchmarks only works if it answers questions or triggers provocative thinking in your own thinking as you try to determine how to navigate what's an incredibly interesting time right now. So please, if you could do that, it would help us immensely.
All right. Well, yeah, thank you, everyone, and have a great afternoon.